Good morning, Wall Street winners. It is Friday, April the 11th, and we have heard from some of the big U.S. investment banks, particularly JP Morgan and Morgan Stanley. You can see in some of the news items in top news on the Bloomberg app that the traders at both Morgan Stanley and JP Morgan took advantage in a positive way of the volatility going on in the markets and led to record revenue in this chaotic market that we're in. So that was positive, and both of those stocks are up, but only slightly, about 1% or so in the pre-market. We'll see if there's any additional rally to those coming. We had futures in the U.S. indices all up right now. We're still an hour out from the open, but certainly a little bit of green on the screen, which hasn't been the norm for quite a while. We still have, obviously, tariffs being the main topic going on and the uncertainty they're creating and the potential impact, maybe unreversible impact to the market. And that's really the primary concern right now amongst most investment folks. We take a look at the Yahoo Finance app, and we've got crude above $60, but just barely. We have the VIX up at just under 43 and having risen this morning. I think probably based on the US-China trade war escalation and President Xi's comments that the escalations and the tariffs from the US are a joke. So it'll be interesting to see how those two countries and individuals, presidents, come to the table and start a negotiation, because they seem to be just creating a greater and greater divide between the two of them. We look at our health and retail, and oddly enough, retail is in the green for the most part, as is healthcare, except Humana in the pre-market. Still a ton of concern here. I mean, even if we don't have the tariffs, there are tariffs that have been implemented, 10% across the board. So there will be price increases. And that in itself is going to affect consumer confidence. But the other tariffs are delayed, and hopefully they won't come into effect because negotiations will take place. But we don't know that right now. And the not knowing and the uncertainty and the price increases are all taking a toll on the U.S. consumer. And again, the U.S. is a consumer-driven economy. So when the consumer is impacted and they stop or curb their spending, even reduce their spending slightly, it has an impact. Now, we've started to just get the first little bit of earnings out of earnings season from the banks, and it looks positive. So I think we're going to see some positive earnings, but if there's any forward guidance, future guidance, it's going to be, we're entering some turbulent times and there's a lot of uncertainty. So hard to make decisions. And when that happens, it can be a self-fulfilling fantasy, because if it's hard to make decisions, people put decisions on hold. Those decisions mean that money to be spent is on hold. Jobs can be impacted. We haven't started to see the ripple effect from the Doge job cuts and layoffs and people who have opted to resign on their own and take the package that was offered to them. We haven't started to see cuts from private and public business, but business sentiment is down, as is consumer sentiment. So that's going to be the next shoe to drop. And I think when we start to see layoffs due to things slowing down, the market is really going to correct. And so I don't think this is a buy the dip moment or enter at these deflated prices. I think you're going to see that these prices are going to go much lower, sadly, before they get higher. So if you are looking for a strategy to put money to work, money market funds are a great opportunity for that have little risk associated with them. and earn a percentage return paid out in interest versus, say, a dividend or a capital gain. That's one option. There are private mortgages that could be another option. A little more risky because people can default on those if you're buying individual or financing individual mortgages. There's private debt. And again, depending on the stability of the company, will be the grading of that debt from high to low, and those can pay a higher percentage. You can also look at call and put options, a more aggressive and more risky strategy, but also one that can lead to higher percentage gains and capital gains as opposed to dividends or interest income, which is taxed preferentially. So you do have some options out there. You just have to look at where you are in terms of your investing time horizon and when you're going to need that money, and also look at risk categories. Real estate, holding real estate, paying down debt is another great way to make a very good return. If, especially, for example, in a country like Canada, where unlike the US, where your interest income on your the mortgage on your personal residence is not a write-off in Canada, it is in the US. Paying off that mortgage, paying off credit card debt that's at high percentages is a great way to achieve a phenomenal rate of return. Now, the key with paying off debt is to avoid getting into more bad debt. And bad debt is differentiated from good debt as debt, the interest on which you can't write off. You can write off the interest on your mortgage in Canada if you take out a mortgage against your home or personal residence and then use that money for investment purposes. So if you borrowed $100,000 and then invested $100,000 in something, could be another piece of real estate, could be a bond, it could be a money market fund, it could be stocks, it could be options. If that money is put to work for you for investment purposes, you can write off the interest. So there's a big difference between good debt and bad debt. Going into technology, shifting gears, we've got a mix of red and green on the screen. The NASDAQ is up. Texas Instruments is off $12. Not sure why it's down so much right now. We are seeing a bit of a comeback in some of the others, but only a small comeback in the tech stocks here. You've got the QQQ down at 445. This is a level, if we take a look at this over the last year, the QQQ was at this level, maybe even a little higher than this level based on where it dipped just the other day, back on, if we get the dates here, in around August of last year. So or even before that, let's call it April of 2024. So if you put money into the into the index back in April, or you would have then made money, but then you would have lost it all and come back to where you were, maybe a little bit under where you were back in August. So, in one quarter, you would have made $0, maybe even lost capital. If you had left it in, you then would have had a great ride up through until February 18th, but then 18th, 19th February, you would have seen it slide all the way down. So this goes to my point of, if you're investing in the equity markets, the message out there from investment advisors and financial advisors is just leave the money in the market. Leave it in. In the long term, stocks go up. And I call BS on that. Yes, in the long term, markets and indexes usually go up. But if you don't sell at peaks and take a profit and then wait for the markets to correct, you are at a serious competitive disadvantage. Markets never continually go up, right? That's just unrealistic. It's silly to even think that they would continue to go up. They reset to different levels for a variety of reasons, but there's always a reason. And when there's not a reason, people make up a reason for things to reset. You need to take your profits and lock those profits in, and then go into a money market instrument or something that pays you a little bit while you sit on that cash and wait for the market to correct. That way you can avoid some of the downturns. So if you were to do that, and I don't think we're at the bottom yet, but let's just say you sold in early February, late January, you wouldn't have you wouldn't have hit the peak, but anywhere in this trough between December 18th and we'll call it January 28th. So you had about a 1 month window to sell and take your profits. And you can see it was pretty choppy in here. And that's probably a good indication that there may be some turbulence coming. If you were to have gotten out and then sat in cash from even, let's call it February 7th, beginning of February, and you're still in cash today, you would be way ahead of the majority of investors that are out there. Once this thing somewhat bottoms out, we'll never be able to know exactly when going into it. You can always look at when it happens afterwards, but wait for the narrative to change, the positivity to come back, and then ride that wave back up. Buy in near the low. You're never going to hit the low, but buy in near the low and ride that back up. That would be what I would encourage you to think about. The only person that makes money when you keep your money invested in the market is your financial advisor, who's taking whatever percentage off of your money, whether you're making money or losing money. So it's set up, it's a rigged game is what it is, and you just need to be aware of that so that you can decide whether you want to participate in the rigged game or you want to do things on your own and manage your own money to avoid the rigged game. We take a look across the board here. Not a ton of huge movers. Netflix is making a bit of a move to the upside there, but it got hit pretty hard yesterday, so not recapping those losses. TSM. So TSM is going to report soon, 6 days. TSM released some numbers yesterday saying that giving some pretty positive updates. I don't know the exact update, but it seems like they're firing on all cylinders. I can't see the actual news article below. I think we're going to see a great report. The concern that I heard yesterday around TSM is production is way up, but they're concerned about inventory levels. So maybe they're producing, but not actually selling what's produced out to their customer base. I don't particularly think that's going to be the case. And I am very bullish on TSMC unless we hear something out of the White House around semiconductor tariffs. And there's always that risk because we don't know when the crazy tweets will come out, but or truths, which is a misleading term, it could be lies as well, come out. But when those statements come out, they can wreak havoc on an individual stock or an entire sector or the entire market. Getting down into financials. So financials have started to announce, I think we're going to see a pretty positive set of earnings from financials. I don't think we're going to see any of these financials really spike big time like they have in the past during these announcements. You can see JP Morgan is up about a little more than $2.50 on good results and earnings. Morgan Stanley up 72 cents, so really less than 1% at this point. Goldman up 5. So there's a lot of room for these to move. I mean, Goldman, if you look back even within the last 6 months, was up close to $700, $671, and this is now under $500 now. So there's definitely room for these to move. And I don't think they'll be as impacted in the next quarter as some other businesses, but they still have some pretty significant exposure to a market that turns into a recession with bad debt defaults or loan defaults. So we'll see. I think they'll make money on the volatility side, their wealth management side. I think M&A will slow down because it has slowed down. Whether it picks up or not in the next quarter remains to be seen. Overall, though, this quarter, I think we're going to see some good numbers out of these banks, and I think they'll make a bit of a rebound. But when they do, I would encourage you to sell. Sell and go to cash and be happy when the market corrects as we head into a recession through the summer months. You'll then be able to buy in the fall at deep discounted prices and ride that up into 2026 and be very happy as you're riding that way back up into 2026 as the economy recovers. Good luck in your trades today.